All right, next we're going to look at financial intermediation in banks, right? So thinking about our financial system. So most nations have a banking system, and most of them encompass two types of institutions. One type is the private banking institutions. So these are institutions like SunTrust, Bank of America, um, right? All of your typical banks. And then the other type of institution is a central bank, which is the Federal Reserve Bank for us here in the United States. It's the bank that is basically in charge of the money supply or monetary policy. And it's not a bank that you and I can use. It's basically the bank for banks. So most countries have this type of financial system set up. All right, so a central bank, like I said, is a banker's bank. It's usually an official institution that also serves as a country's treasury bank. So we have the Treasury Department is a part of our federal government. The federal government is also the central bank is the federal government's bank. So that's the other thing too there, right? So that's what that means, the country's treasury bank. And so not only are they the banker's bank, not only are they the federal government's bank, but they also are sort of the regulator of banks. So they institute and come up with the rules of how banks can operate. And so, what are the main purposes of banks? Well, one purpose is to finance things, right? Provide loans. So there are two different types of finance, two different ways that people can borrow money and institutions can loan money. So one is called direct finance. So this is when, for example, Delta sells bonds that you and I can purchase, right? This would be direct finance. So if I want to loan some money to Delta, I can buy a bond from them, which basically is a guarantee to be paid back some amount of money that's more than what I loaned sometime in the future. That's what a bond is. And that's how direct finance works. It's when individuals give money directly to businesses or whoever is being loaned money. But then there's also indirect finance, which is how a lot of finance occurs in our country. And that's basically when you put money in the bank and the bank lends that money to businesses. And so in that way, it's indirect because you yourself are not directly lending to these businesses. You are just putting your money in the bank to save for some later date. And then the bank uses your money that you're saving with them to lend to businesses. And so this whole process of indirect finance is done through financial intermediation, right? The process by which financial institutions accept savings from not only you and I, but also businesses, as well as governments. And then they take those savings and lend those savings to other businesses, households, and governments, right? So this whole system is called financial intermediation. And the institutions that perform the financial intermediation are called financial intermediaries. Hopefully not surprisingly, right? So for the most part, banks, right? Commercial banks like Bank of America, SunTrust, but also other institutions that aren't necessarily banks are also financial intermediaries. All right, so this is sort of a graphic of the financial intermediation process. So households, businesses, and governments save their money in financial intermediaries. Maybe it's commercial banks, could be savings and loans banks, savings banks, credit unions, insurance companies act as financial intermediaries. Mutual funds, pension funds, and governments can also act as financial intermediaries. And then those financial intermediaries loan what these agents or what these individuals save with them, and then they loan those to other households, businesses, and governments. Okay, so this is the process. So this is indirect finance in action. Okay, direct finance basically skips the intermediary, goes straight from here to here. That would be direct finance, right? If there was an arrow going from here to here, that would be direct. This process through the intermediaries is indirect finance. All right, so here's a question for you. Why might people wish to direct their funds through a bank instead of lending directly to a business? There's several reasons. It could be that there's asymmetric information, which we'll talk about each of these, by the way. Could be due to something called adverse selection or moral hazard. And then on top of that, the large scale and lower management costs of these intermediaries make it cheaper in terms of transaction costs. So we'll talk about each of these in more detail. So the asymmetric information issue is basically the fact that you as an individual don't know, you don't have as much information about the risks involved in lending to a business directly. But a bank is going to be better able to have more and better information about the risks because of their size and their resources. And so this is one reason that there's less direct financing going on than there is indirect financing, is because of this information asymmetry. The asymmetry just means that the business has all of the relevant information, and then you as the direct lender do not. So there's an asymmetry there. They have a lot of information, you don't, and so that can pose a problem when you're lending, right? You don't know how safe the business is in terms of getting your money back. So that's one issue. Adverse selection. So this is the tendency for borrowers to use their borrowed money for high-risk projects. So I like to talk about another example of adverse selection that is not related to banking and finance, and that would be regarding insurance. So suppose that you knew that you were going to get sick next week, and because you knew that you were going to get sick next week, or not even that you knew that you were going to be sick, but suppose you were going to, say, Mexico, and you knew that there was a high probability of injury or some need for medical insurance, and because of this need, you decide to purchase health insurance right before you go to Mexico. Okay, that's called adverse selection. You are selecting insurance only in an instance when you know that there's a high risk, that a high probability that you're going to need it. Okay, so that's kind of adverse selection in a different context, but that's basically what's going on here with lending and borrowing. It's the fact that the person borrowing the money knows that they're going to use it for a high risk project. And so that's why they borrow the money rather than using their own money, right? That's kind of the idea with adverse selection. Something related to and very similar to adverse selection is called moral hazard. And this is the possibility that a borrower might engage in riskier behavior after they've received the loan. So the difference here is kind of, this is before and this is after, okay? And I can use another example in a different context, also using insurance to sort of give you a better idea of what moral hazard is. But this is basically the idea that when you have car insurance, you drive less safely because you know that anything that happens will be covered by your insurance, right? So after you have it, you act less safely, or once you have that health insurance, you engage in riskier health behaviors like smoking cigarettes or eating, greasy fast food and having a poorer diet. You stop exercising, those types of things, right? So these two are very similar, but really the main difference is that this is beforehand, right? So this is the case where you know that there's a high probability of needing health insurance, and so you get it. And then this is, once you have it, you act less safe regarding your health, right? So that's kind of the two there that are very similar. And then the last reason, right, large scale and low management costs. So when you save your money in the bank, lots of other people are doing that too. And so in that way, there's kind of this pooling of funds going on within the intermediary. And this allows the intermediary to reduce costs and risks, right? So rather than each of us individually deciding who to lend our money to, we could just pool all of our money and let someone else take care of it. And they can, rather than each of us investigating the risks and rewards of lending money, it can be put into a centralized system where one person or one entity does that research for us, right? So that's kind of what's going on there. And so examples other than banks are pension funds do this, investment companies, as well as government-sponsored financial institutions such as the Federal National Mortgage Association. So not just banks out there doing this. All right, and lastly, we're going to talk about some basically some issues regarding what's known as a balance sheet. And this has to do with financial intermediation and lending. So we need to know what liabilities are. Liabilities are amounts that are owed. So if you have borrowed any money and you have a debt, you have liabilities. You are liable to return the money that you borrowed back to the person that or entity that lent it to you. And so these basically are legal claims against a business or household by non-owners, and the sources of funds for financial intermediaries, right? So when you put your money in a checking account with the bank, they are liable to give that back to you. So that's what we mean by this last bullet point here. The money that they lend is a liability. They owe that back to the people that deposited it with them. Sort of the opposite of this are assets. So these are amounts owned rather than owed, right? So if you own a car, that is an asset. If you own a house, that is an asset. If you own some stock in the stock market, that is an asset. So these are items to which a business or individual or household holds a legal claim to, and these are the uses of funds by financial intermediaries. So when the bank loans money to a business, that's a liability to the business they loan it to, but it's also an asset because it's what's owned. The bank owns that money that needs to be returned to them at some point. All right, here's just a table of different intermediaries and the types of assets and liabilities that they might hold. So commercial banks and those types of things, credit unions, they have all different types of assets, right? So a car loan is an asset to them because it's money that they own that has to be returned to them. Other consumer debt, so other loans, basically any type of loan, home mortgages, right? These are all assets to these types of intermediaries. Whereas as far as their liabilities go, transactions, deposits, so your checking account with a bank, that's a liability to them. They have to give you, they owe you that money back, right? So it's an amount owed back to you, so it's a liability. Same with savings deposits and other things like that. And then here's some other examples, and you can see that basically they're very similar types. Here, you've got pension and retirement funds. The assets, the types of assets they hold are things like stocks and bonds. They also sometimes hold mortgages. But what do they owe to people? Well, they owe people their pensions, right? Their retirement funds. So there you go. All right, so let's look at an example. Customers pay fees to hold hundreds of billions in deposits at banks. So recently, some U.S. banks began charging interest at 3.5% to 5.5% on deposits of at least $300 billion. One reason for the charge is that new government regulations made it more costly for banks to hold these funds. And so they have to be compensated for that, right? If it's going to cost them money to hold it, then they need to be compensated. Another reason was that there have been low interest rates on loans and bonds, which make these deposits basically unprofitable without the imposition of storage fees. So this is actually a pretty interesting issue given the current situation where we have short-term interest rates which are basically at zero. So lending money, banks lending money is not profitable right now. So we might see more of this for lesser amounts of money. All right, and then here's an interesting little graphic on how a debit card transaction clears. So when you use your debit card, this is what happens, right? So suppose you've got your debit card, you bank with Bank of America, and you go to Macy's department store and you buy something for $200. Well, Macy's banks with Citibank, so that debit transaction first goes to Citibank, which is what Macy's uses. That's Macy's Bank. And then Citibank basically contacts your bank, Bank of America, and withdraws that money. So there's this sort of chain of events here. You use your card to buy something at Bank of America, which banks with Citibank. They get their money from Citibank. Citibank gets that money from your bank, Bank of America, and that comes out of your account. Pretty straightforward. All right. Before we wrap up this section, let's look at one more example, an international example. Why bother with a debit card when payments can accompany tweets? So this is pretty interesting too. Banks in France, India, and the UK have allowed people to attach transferals of payments to Twitter messages. So you might have seen this with Facebook too, that you can pay with Facebook. The amount of such Twitter-directed transferals of payment from bank deposit accounts already exceeds $7 billion and has been growing at an annual pace greater than 25% annually. So an interesting development in the way that we make payments